It's been running a little bit late, so we'll try not to add to that. So my name is Claire Richelieu, for those of you who don't already know me. I'm the new head of the Mainstreaming Climate in Financial Institutions Secretariat. Very happy to be here, to be welcoming you here today for the discussion. I'm very pleased to have the three of you here with us today physically, and we also have three of our partners online who will be joining the discussions a little bit later on. So today's discussion is about climate risks and how your various institutions manage climate risk and what the journey has been for you managing climate risk. And I'd like to thank IDFC for co-hosting and organizing this event with us today. And I'd also like to thank my colleagues that are here with me, Alice and Sarah, that have been working on this also today. So we'll be starting the discussion with a short presentation from myself, but I'll try to keep it very brief for the sake of time. And then David Klein, who's here, will be giving a keynote and presentation of his work on this. And then we'll be hearing from five different institutions on their management of climate risk. So I think I'll just start now. I'll probably start with the presentation straight away and try to keep it as brief as possible. So I'm going to actually talk to you a little bit about our initiative. So we're the Mainstreaming Climate and Financial Institutions Initiative, and we bring together 53 institutions to help the public and private institutions to help them work on their journey in climate mainstreaming. So it's a variety of institutions from across the world, various sizes and shapes, who get together based on the discussions that took place in Paris in COP21. And our initiative aims to help them better reflect on three different issues. The first one is climate risk, which brings us together today, and climate risks and opportunities. We also work on climate mainstreaming more broadly, and finally we work on aligning financial flows. So these are really the three key focuses of the discussions that we organize and what we bring together the financial institutions to talk about. So yeah, next slide, please. So these are the 53 financial institutions that we have today that are supporting us today. So it's a free initiative. You can join freely. We try to provide a space for us to exchange freely on the variety of climate mainstreaming journeys that everyone is having, and also to lead by demonstrating what can be done and best practices in these various topics. So next slide, please. Yeah. We structure our discussions around, we have one key common definition of climate mainstreaming, and then we structure our discussions around these 5 principles that basically organize the way the climate mainstreaming journey is set up and provide a framework for financial institutions who are beginning their journey to start implementing actions, and also for the ones that are a bit more advanced to structure their thoughts. So the one we're going to be focusing about today is climate risk. We'll be looking at how to assess and how to manage climate risks, whether they be physical, transition, or liability risks. And I think we can move to the next slide. I'll try and keep it short. Again, how we do this is we work basically on organizing events, giving financial institutions a space to discuss, to exchange with their peers, through a program of webinars, side events like the one we're organizing today, and by sharing reports and resources and the latest developments on each of the topics that I was mentioning. So we're just about to we've just published and we've just launched actually our biannual report, which gives a very good, I hope, overview of the latest developments that we've observed as the Secretariat of the Climate, the Mainstreaming Climate Initiative in the climate mainstreaming world. And we've organized it along three different topics that I was mentioning earlier. One of them is climate risks, and I won't go into too much of this because I know that David here will be providing a more expert and more detailed overview, and we don't have that much time. But basically, if you want more information on our observations and what our supporting institutions have been doing, I'll invite you to refer to our biannual report, which is available online on our website. So with that, I think I'll just pass it over to you, David, from UNEP FI. So you're a senior advisor on climate risk with UNEP FI, and you'll be, I think, giving us a little bit more insights on the latest climate risk assessment methodologies and tools that you've observed over the past few years. Thank you very much. Do you want to stand up?
Yep. So thank you so much. It's really lovely to be here, and I'm very excited to speak with you about this important topic, because I think we are at a state in, and if we go to the next page, what we're going to do is talk a little bit about some of the work that has been conducted at UNEP FI through the climate risk program. But I think it's a really timely point to do this, because the disclosure regulations that we see from the International Sustainability Standards Board, the work that have been developed under the TCFD over the last several years, these things are beginning to come to maturity, which really then begs the question, how do we actually analyze? How do we quantify? How do we really put decision useful information in the hands of decision makers? And I think whether you're talking about a development institution, a commercial bank, a retail bank, an investor, across the financial sector, there really is a need to quantify both the physical risks of climate change as well as the transition risks, because climate change is not just a sustainability priority, it's a strategic priority for the financial sector. And so the work that we've done with UNEP FI over the past few years has been to develop capabilities for financial institutions in doing this type of work. And so one of the things that we had done was create a climate risk landscape, a look at a variety of different tools and a perspective on those tools, not only some of their strengths and weaknesses, but actually earlier this year getting a large number of institutions to actively sign up and use these tools and do case studies through their use of them. And I think that was a really valuable way not only to show how these tools work, the comparative methodologies, but also do a bit of explanation and exploration of what the institutions are learning from using climate tools overall. So we had worked with ETH Zurich and a large number of providers, as well as over a dozen of our members, to put together case studies on different tools that we assessed. And so over the next couple pages, I'll talk a little bit about what did we learn from that and what are some of the lessons that we can take home for you and for your organizations as you consider climate risk and begin looking at quantification. So if we go to the next page, please. So there are a number of developments in this very fast-moving space. If we look back at 2018 or 2019, I think the world of climate analytics is totally changed from there. It is vastly expanded. We're seeing a large number of institutions partnering to provide either new data. This is especially true on the transition side when it comes to emissions data. It's also true on the physical side when it comes to local physical risk data. But we're also seeing a growing need to develop analytics that are going to meet regulatory demands. And this is one of the key areas that we're seeing a need not only to use these tools internally, but use them for disclosures that are required, use them for stress testing, and use them to begin making decisions that will then go into publicly facing outputs. As a result, people are really interested to get a more holistic perspective on both the physical and transition risks. And so when we had done exploratory analyses, these were things that were typically done separately, a physical risk assessment, a transition risk assessment. Now what we're seeing more and more is an integration to try to get that all-in number because of the impact it may have on your strategic priorities. A couple other points I would note here. I think we're seeing the underlying data getting better, the granularity improving, whether it's looking at the network on greening the financial system, their scenarios with new variables for different sectors, or local physical risk data that's covering hazards perhaps that hitherto had not been fully covered or fully explored. And so all of that, though, speaks to the fact that financial institutions themselves are becoming much more informed consumers of tools and informed consumers of the analytical methods. And that means that there's more tailoring to their needs and more tailoring to what they're interested in getting out of the analyses. And so as a result, what we're seeing is this kind of mixture typically of a consulting and a structured approach. The consulting element used to tailor that approach to the institutions in question. And I think all of these things result in stronger tools, result in answering more of the questions people want to get answered. But also there are still some limitations and things that I think have real implication for your organizations as well. So if we go to the final page, if we, great. Go to the next page. We still can see, as we see on this page here, that there are a number of areas where these tools are still not fully meeting the needs and not being fully fit for purpose for institutions. And it doesn't mean we can't learn a lot from them. I think institutions learn how to quantify their risks. They meet their regulatory requirements using such tools. But I think the big lessons learned, especially in places that maybe aren't as developed in their climate risk analysis, is to recognize what the limitations are before building a framework around a tool. And that's going to ensure that the assessments that you follow are going to be a lot more effective and a lot more impactful. And so a few areas that I would highlight to make you informed consumers as you consider both internal as well as external methodologies include thinking about the input data. A lot of times the best data is going to come not from an external party, but from you and your clients, at least when it comes to decisions around overall market risk and credit risk. Climate data may come externally, but some of the difference makers are really going to come from what you and your clients know and understand. The second piece is thinking about the scope of risks. A lot of times we worry that institutions will think that they have a clean bill of health on climate risk because they've only seen from an assessment the first order risks. I think this often is a limitation of many tools, which is saying, how much would I lose from a single physical event? Not calculating necessarily that higher insurance costs may impact valuations in the future. Not calculating that lower demand overall may affect the market for fossil fuels and other carbon-intensive commodities. So recognizing that these second order and contagion effects exist is an important consideration that tools are still working out how to do. Next, I would say that there's still a need to make sure not only that institutions who are using the tools understand them, I think that's at bare minimum, but that decision makers understand them. I think there's increasingly been a risk where we see those who do climate and sustainability analytics able to work on these things, but then it's about communication. How do they communicate this to their boards, to their senior executives? And if the results are not going to be understandable and the conclusions won't have business intuition behind them, then they're not going to be adopted as part of a strategic decision-making process. And so this is one area where tools can improve, but also where that communication is so important. I'd also talk about, in terms of assumptions, this kind of gets back to that prior point, which is when we're really thinking about the assumptions within these tools, we also need to consider fitness for purpose. If we're going to use underlying models that are long-term scenario models, then looking at the short-term risks using them may not give us a full picture. So suitability of use cases is really key, as is the consideration of assumptions. A model that was never meant to look at volatilities in, say, commodity prices is probably not a great model to evaluate the overall health over 12 to 24 months of, say, a metals or mining concern. And so understanding not only what assumptions are in the methodology, but what are the underlying models? What are the underlying assumptions that are being used? Are these long-term scenarios? Are these short-term shock scenarios? Are they considering only physical risk? Are they fully integrated? These are questions to be asked because they're going to affect the ultimate results, the ultimate potential for losses. And then finally, I think one of the key areas is really offering more guidance. And this kind of ties back to everything I've been saying, which is that tools should not just serve a purpose of putting together an output for a stress test or for a disclosure. While that's good, if that isn't going to move how you make decisions, then all you've done is put words on a page. All you've done is put graphics on a page. And maybe that meets a demand, but it's not managing your risk. And so if we want to go from risk reporting to risk management, it's incredibly important that we really think about how this gets integrated in terms of then not just the negative, but the opportunity side, not just the overall decisions about individuals, but really thinking of how this applies to portfolios collectively and to strategic choices. And so these are some of the areas where I think tools are continuing to work, but I don't think it's ever the case that tools will answer all of these questions. I think it's more a matter of you and the organizations that you work with directly having the open dialogue to ask these questions, to be transparent in methodologies, and to continue to revise and refine. Climate risk in that way, I think, is exactly like every other type of risk, which is it's fundamentally about operating under conditions of imperfect information and uncertainty. And this is the challenge. This is the fundamental point of finance overall, is we don't know for certain what the future will be, whether it's on a retail mortgage, on an infrastructure loan, on an investment. But the goal is to understand better than those elsewise in the marketplace, and also better understand for ourselves where we can be de-risking and where we can be seeing new opportunities. So I think the process of going through these exercises, the process of exploring these tools is valuable, even if they aren't the end-all to giving you the final numbers on your losses or the final decisions that you're going to take. So I think that I hope sets things up well to hear from a number of really thoughtful institutions, and getting their perspectives on this, I think, will hopefully bring to life some of the more theoretical and conceptual ideas that I've brought up over this brief keynote. So thank you again, and I'll hand it back to you, Claire.
Thank you very much, David. I think that was extremely insightful. I mean, you're one of our long-term partners, and we know can only encourage you very warmly to take a look at the recent report that you've just been publishing on climate risks, and it's always you always have a very pragmatic approach to managing them, and recognizing, I think, also the challenges, which is also very useful to all of us. Thank you very much, David. So as you said, I think now we'll be interested to hear from the financial institutions themselves. And now, again, we have two of you that are with us today. So thank you very much for that. I'll start with you, if that's okay, the ones online. So we have, well, I'm sorry, I hope I'm not going to mispronounce your name. We have Orçun Yıldız'a. You're a manager engineer in the engineering department at the Industrial Development Bank of Turkey. Welcome with us today. We also have sitting next to you Laurent Bergada. Welcome. You're a sustainable finance expert at the strategy division at AFD. We know very well. And also online with us today. So we have we can't see them right now, but we have thank you. We have Effie Ritter, who is Associate Director, Head of Climate Risk for EBRD. We also have Amal Benissa, Head of Sustainable Finance for Bank of Africa. And last but not least, we have Rodrigo Tosta, who's a manager at the Environmental and Amazon Fund Management Department at BNDES, the Brazilian National Development Bank. So thank you also to the three of you for making time to connect with us today online. So I think what we sent you a couple of questions, and you all had the same questions. The first one, we'd be interested in hearing a little bit about your various climate risk management strategies, and how they were initiated, what they cover, and what the main challenges you've been seeing with that are. So we only have one microphone here, so if that's okay with you online, I'll start with the two panelists that are here, and then we'll pass it over to you. I'll probably start from the left. I think for the sake of the slides, we'll start with you, Orçun, if that's okay. Yes, that's okay, because your slides are coming up.
Yeah, sure. Can we start with the presentation? So, as TSKB, Industrial Development Bank of Turkey, we have a development purpose. So the main driver for us for the climate change risk assessment was our development purpose. So, but our sustainability journey really goes back to 1980s. So we began with evaluating our environmental and social risks through the projects in 2005. We started to evaluate the project level environmental risks, and after that in 2019 we started establishing a climate change risk working group. The working group was established from various departments, people joining from the various departments. So we aimed to get the same level of understanding of the people in the bank. In 2020, with the support of EBRD, we joined the Phase 2 banking pilot program of the TCFD. After that, we continued with the Phase 3. Then last year, we became the supporter of the TCFD. And in May 2021, last year, we published our climate change mitigation and adaptation policy, which drew a general framework about the climate change mitigation and adaptation. And also last year we published our Turkey's first climate change risk report in line with the TCFD recommendations. And we started some pilot runs last year about the climate risk evaluation tool. Finally, we have developed it and internalized it to our project evaluation process. Now we have some targets. Our main target is to have the verification from SBTi for our GHG emission reduction. We can go to the next slide. So as the output of the Phase 2, we generated our TSKB's heat map. It's based on sectors and subsectors and also some certain physical risks, and also we evaluated the transition risk as well. The climate risk evaluation tool based on scoring of the physical and transition risk separately. Now we are integrated this tool to our loan evaluation and allocation process. We can move to the next slide. And as I said, we have published our climate change mitigation adaptation policy. It draws general framework of the 6 main pillars. These are mitigating, adapting climate change in all fields of the bank's activities, evaluating the climate change related environmental and social impacts through both investment and working capital loans, and supporting SBTi through reducing our GHG emissions, and integrating the physical and transition risks through our climate change risk assessment tool, and transparently share all our objectives, targets through reporting, and finally supporting the TCFD and aiming to report in line with the TCFD recommendations. While we were doing the climate change risk assessment tool, we of course had some challenges and difficulties. So main challenge, we saw that all the TCFD headings are okay in line with the banks, but we saw some not alignments with these reportings. So maybe in the near future the alignment with the reportings of the banks could be on the same level. And also we had difficulties to reach some open source, not open source data in national level. We had some difficulties with the data availability. So in the future we just expect from national bodies, policymakers, to make available the potential data, especially for the evaluation of the physical risks. Thank you.
Thank you very much, Arshun. I'll pass it over to you, Laurent, because I believe your slides are coming up next. If you could tell us a little bit about your climate risk strategy.
Thank you. I was told there was an online slide first. Okay, so maybe next slide, please. Next slide. Thank you. Right. So in 2017 at AFD we developed a strategy around climate-related financial risks, structured around 4 main pillars.
Number one, integrating climate risks into our operations and risk management. Two, supporting our client financial institutions as well as central banks and regulators in adopting climate risk frameworks. Three, mobilizing climate-related financial risks for policy dialogues, and in particular for energy policy and economic policy dialogues with our partner governments. And four, outreach and contributing to the general uptake of climate risks in the international financial community. Next slide, please. So on the managing of our own climate risks, over the past few years, with an intensive investment on the part of our risk department, we've developed basically what amounts to a simple screening tool, allowing us to, on the basis of country and sector information, as well as yes-no answers to a specific set of sector-dependent questions, to basically, this allows us to identify quickly whether a particular counterparty or project is exposed to significant risks, either on the physical side or the transition side. And if we do have a red flag on either one of these 5 climate hazards, sorry, this slide is in French, or on the transition risk side, then our operational teams engage in additional detailed due diligence on those specific risks. And this additional due diligence is carried out with the help of interview guides that we've also developed in-house, which are sector specific. So this is our general approach on managing our own risks. Maybe next slide, please. Yes, and when it comes to engaging with our partners on their own climate risks, we've chosen to take a broad view of what climate risks are, and basically take into consideration not only financial risks but also economic and social risks and opportunities. And we do this with a wide variety of actors, so companies, financial institutions, but also municipalities, states, central banks and governments, but also line and sector ministries. Next slide, please. And no, can we go back to the previous slide? So I wanted to insist on the fact that a risk is a risk, so a climate hazard or a transition risk, but then it translates not only into financial losses for companies or asset downgrades in financial institutions, but also in lower fiscal revenues for governments, or a lesser ability to conduct long-term sectorial strategies when it comes to governments. So this is why we take this wide approach. Maybe next slide, please. When it comes to financial systems in particular, we work, I've mentioned this already, both with financial institutions, but also with central banks and governments and regulators, sorry, basically to support the development of climate resilient and low carbon financial systems. And climate-related financial risks are an important component of this strategy, although not the only one. And basically, we are in the process of increasing the share of our operations where climate risks play a key role, mostly through the help, through the technical assistance components of our operations with these different types of actors. Next, and one timely example of this is the signing just last week, actually, of a 140 million euro finance in common program with Egypt's 3 main public banks, as well as the central bank and regulator of Egypt, where we have an important technical cooperation component designed to help not only the financial institutions that we work with, but also the central bank and regulator develop climate risk frameworks. Next slide, please. Yes. And more broadly speaking, when it comes to public policy dialogue, we've developed and invested in modeling tools at AFD to support our dialogues with our partner governments. One of these programs is an internal macroeconomic modelization program called the GEMS program, and we use this to analyze both transition risks and physical risks as they relate to economic policy in a number of different countries. We've also developed a more bottom-up approach with a microeconomic and financial approach to climate-related financial risks, allowing us to work not only with governments but also with particular companies or financial institutions that are affected by these risks. So this paints a very quick overview of our overall approach, which is, as you've seen, heavily geared towards client and partner engagement, but on the basis of a clear understanding of our own risks. And moving forward, basically, we will try and increase the synergies between these four components of our climate risk strategy, basically making the risk department, operational teams, climate teams, work together in a more synergistic fashion.
Thank you, Laurent. That was very insightful indeed, and I think it complements really well. I mean, what you've been doing on a probably more broader scope with what the Turkish Development Bank has been doing internally as well in their financial institution. I think we can move forward and get more from all this. So we're lucky enough to have a commercial bank, another national development bank, and a multilateral development bank with us today. So I think that will also complement this discussion. I'm not sure who to start with. Should we start with Effie, because you're on top of my list. Effie Ritter, so if you could tell us a little bit about what the European Bank for Reconstruction and Development has been doing in terms of risk management, and I'll leave it to you. Yes, your microphone is unmuted, so that's perfect. Thank you.
Thank you, and good morning, everybody, and thank you for the previous presentations. Manage our partner banks in their transition into a more resilient and more of ability to assess their financial risk. So we've established here a corporate governance climate hub. And the intention actually for that hub is to support financial institutions improve their own internal governance, improve their own internal identifications and managements of climate risks into their own decisions and to their strategies. So that's part of the drivers that drove us to assess our own risks, and ultimately why we want to, and we use that to support our clients and our financial institution partners as well. In terms of strategy, there's probably 5 pillars actually that we laid out in that strategy, and it's also quite transparently laid out in our TCFD report, which we published just last week. So hopefully that will be something that some of you can have a look at and see. But in that, we actually lay the foundation of our strategy. So we start from actually saying that we actually have a strategic and capital framework, and that's our key planning strategy for the bank. And in that strategic framework, we actually labeled that supporting transition to green and low carbon economies is one of the core 3 strategic objectives of the bank. Since 2015, we've actually launched an initiative that's called a GET initiative, and that's green, which is actually green economic transition, to make sure that whatever we are financing, the flows of funds that we're financing to our clients are actually considered green, and they actually help them transition into a low carbon economy and low carbon pathway. So that's the second strategic objective that we had. The third one came essentially last year. We made that declaration, our board made that declaration, and that is for the bank, for all the bank's operations, from our flows to our portfolio, to our pensions, to our own operations. Can you hear me okay? Sorry, I just heard a bit of a noise. Yes. Okay. So for all of those operations across the holistic operations that we do, to be Paris aligned. And what that means is that every transaction that we come and look at, every transaction that we look and see, we check that it's Paris aligned. And conjunctly with that, we also assess it for carbon transition risk and for physical risk. So that's the second strategic objective, a key strategic objective that we have. And then, third. And then finally, the one that I'll actually group them together is actually we have country and industry strategies to support the transition and to manage and deliver the climate-related objectives for those sectors and for those countries into a low-carbon world, into a low-carbon economy. So that's looking at strategic objectives. Now, finally, I think that one of the points that some of my colleagues on the call have addressed, what are the tools that we're using? And this is actually where Unify was very helpful for us at the beginning. And I think that you'll start to see some themes emerging from how we all look at that. There are more details about how we assess it in our TCFD report, but we also look at carbon transition risks and physical risk. And on the carbon transition risk, every project that comes, every client that comes, we will assess them for a carbon transition risk, similar to how my colleagues actually mentioned. We would look at it in terms of what is the sector, what is the country, and sometimes we would actually look also at the tenor, because the tenor from a risk perspective would also have implications in terms of how long they would be and what would be the changes that could happen over the tenor of the time that we're involved with this project as well. For physical risks, and this will probably go later into some of the challenges, and something that David Carlin addressed as well. There's no easy way to do physical risk. So we do look at sectors, we do look at countries, but ultimately for our clients, we need to go back to them and ask every single one of them to actually get geolocations of the key assets, of key suppliers, of key concentrations. And those geolocations, we would actually run in a tool that we developed and see what's the likelihood of various acute or chronic event affecting them. And once we see that there are ones that come into a more sort of higher risk category, then we engage. Then we engage actually in a more extended due diligence to understand whether there could be certain areas that we can support them become more resilient, or as in some cases, the clients themselves are already aware, and then we note that so that we actually are aware that this is actually being addressed. So that's part of the assessment and the tools that we use for assessing that. I'm referring to David Carlin because I think that a lot of the areas that we've actually done, we've actually taken from the Unify, and we went through that journey over the past 3 years to the point where I think we're relatively advanced, but we still have a way to go. And when we look at our tools, we look at tools because we use them to collect data. So that's where we actually are going directly to, seeing if there's data that we can actually collect and purchase. We use that data where we can actually do the initial screening so that we can get a sense of which ones are the higher risk ones, which ones are the ones that we want to do focus our additional attention to. And then on top of actually having that discussion and doing the due diligence, then we stress test those results. Then we apply actually scenarios and shock on each individual clients. We do that on the clients that are actually seemed as high risk on a case-by-case basis for those. And we do it also on a portfolio. So we can actually understand what is the overall outcome that we have. And once we've done that, we use that then ultimately for reporting purposes. And reporting purposes could either be an external documentations like the TCFD, or it could be for internal purposes. So we understand what are the concentrations of risks that we have in certain areas, what are the concentrations of risk that we need to manage and look at, what are the watch list areas that we want to look at so that we know that we're actually more exposed to those. And that's how we look at managing those risks. Now, the final point and the final question that we were actually asked to talk about is what are some of the challenges that we're facing? And in fairness, there's been a lot of progress over the past 3 years. That's true that tools that didn't exist then do exist now. But as a development institutions today, still most of our clients don't have the information that we need to make actually the clear assessment. So it is going to be a time and over time actually collecting that data. So I'm starting to say, geolocations is something that we're doing on a case-by-case basis for every client that we see. What we see that we still don't have enough, for example, would be actually the emissions. Not all our clients report on emissions. And while we do have tools and actions and plans to help them do that, that's not something that is a process that will take time to do. It's not an overnight process to do. And the emissions of our clients aren't reported anywhere. So this is where actually looking at tools to perhaps provide proxies, perhaps provide alternatives, knowing some of the limitations of that, disclosing the limitations of that, and then using that as a way that we use it. I think that while there has been some consolidation, there is still quite a lot of theoretical and conceptual high-level expectations in the field. And when we deal with our clients, sometimes we have them asking us, well, what does 1.5 mean? What does it practically mean for us to do? How do you align to net zero? What does it actually mean? So it's actually bringing it down to the action points, the implementations of actually taking those high-level conceptual theoretical disclosures or expectations and bring it down to how do I actually do it? Because there's a lot of uncertainty, and there's still a lot of there's still some disorganization perhaps, and a lot of informations and brainstorming that's happening. And our clients really want to understand, just tell me what to do. And this is why, by actually championing it ourselves, this is what we try to bring down to our clients as well. And the final point I just wanted to clarify on challenges is that I think there is a challenge of fear, both internally in our bank, and also we know from our clients, there is a fear because it's a question, what is this actually going to mean if I take, for example, in our countries, 80% of our economies that we work with actually still rely on fossil fuels as a way to heat their homes, to generate electricity, and to drive, and to generate hot water as well. And the fear of actually saying, well, does that mean that I won't be able to do that because all of a sudden this is going to change? Am I not going to be able to generate steel or have cement so I can actually pave my roads and my streets? And there's a big fear factor of thinking, okay, does it mean that I can't do that? And it's really actually a process of hand-holding them and saying, it's not something that, it's not going to happen overnight, but what we expect from our clients and need to see them doing for our engagement is to see, okay, you have a plan. This is where you are today. This is where you're going to go tomorrow, and this is how you reach that. And then having transition plans for each and every one of our clients, where we actually have KPIs, where we have actually covenants, or areas where we actually have a process over time to deliver reasonable results that get us into an overall net zero pathway. So I will close with that. Hopefully you heard me okay, and pass to my colleagues Amal or Rodrigo. Thank you.
Thank you very much, Effie. I think that complemented what we were saying here very well, and interesting to see what you've been doing with your clients and also what you've been doing internally. I'll pass it over just to Amal first out of the two. I'll just picking you first because you're the closest to me on the screen. If you could just take us through your mainstream journey. I know you're going to have some interesting things to say, as we've already discussed this with you very recently for the publication of our report. So thank you, Amal. Over to you.
Thank you very much, Claire. Good morning. Can you hear me well? Yes. Okay. Perfectly. Well, I was thinking how best to avoid lecturing you today. I know we're among a lot of experts. Also, to drive really the perspective of a Pan-African financial institution that's been doing its voluntary approach. And of course, we're a commercial bank. So today, The idea is, how does a commercial bank take in all of this, and how does it integrate that in its strategy and, of course, in its risk management and opportunities. So breaking it down into 3 points. The first thing I want to tell you a little bit is about our journey and our positioning in general over the last 15 years, and take you through kind of the strategic positioning of our group on a voluntary basis. And I want to stress that, because in this part of the world, there's really few regulatory drivers. Started a few years ago, but there's really nothing like that. And also with our partners. The second thing I want to take you through also in a brief manner, and of course we can get in deeper, mindful of the time, is talking to you about our ENS risk management system and how really the climate risk approach grew out of that. It was very important for us to have a mature ESMS to even begin pondering climate risks and its complexity. And finally, I want to stress a very, very important aspect that we've learned a little bit the hard way in our last 20 years as a sustainable finance leader, which is don't focus only on risk, always have a double-pronged approach to integrate opportunities. And it's certainly very, very pertinent for climate. So the first, I don't have any presentations for you today, because I thought it would kind of drain us and keep us, you know, in a very linear fashion. And I also really appreciated, however, the slides that were presented before. So thank you very much to the participants. It's clearly just a choice. So first of all, Bank of Africa is a Pan-African banking group, which offers universal banking services. We're a huge group, but today I'll talk about the bank, which is present in 32 countries worldwide, 23 in sub-Saharan Africa. We have Moroccan roots, so our headquarters is Morocco. Morocco is the mothership that kind of instills and amplifies whatever it does in Morocco across our other subsidiaries, because for the last 15 to 20 years, I feel comfortable saying that we are a recognized sustainable finance leader for a few reasons. The first of which is, first of all, the vision came from the very top early on, and it's very critical. Back in 2000, and actually even earlier, apparently in 1996, a colleague was saying we were the first African financial institution to get on board UNEP-FI, which is the finance initiatives of the United Nations Environment Program. So can you imagine how long that is, when even it was all about, you know, planting trees and seeing how nice we could be to the community. There was a foundation being set up. But very early on, we took in the language of the UNEP-FI to say, you know, the financial sector has a key, a crucial, fundamental, central role to play in sustainable development. So already we were kind of getting on board sustainability as a strategic pillar. And then a few years later, that through our first loan with IFC, we put in our first ESMS. So the first years of the SMS were a little bit rusty. Can you imagine also the resistance at the time? No other bank was doing this. So the bankers are saying, do I get a bonus for this? Is this really my role? I've never really benefited from any training. And even when you do train, it's very hard for them to accept that just for a few ENS impacts that we could actually block any kind of financing. And we finally moved to doing that. In 2010, we became among the first regional banks in the MENA region to become an Equator Principles bank. So that was the first time we put our proverbial money where our proverbial mouth is, in the sense that for all projects, $10 million and more, there needed to be an environmental and social due diligence, and it became contractual. So we report publicly on this, and without going into much detail, with the ESMS and the Equator Principles, these were our first real basis points for even looking or beginning to understand the idea that extra financial risks, or ESG, and what it was and how to integrate that in the loan book. So it took about 10 years to get our ESMS in maturity. And by the way, in parallel to what was being done in Morocco, again with IFC across all our subsidiaries and Bank of Africa on the African continent, we have a fully functioning ESMS. And now we're actually in the process of integrating working loans. So obviously going beyond climate risks, Took us about 10 years, like I said. In 2018, we were at a conference actually with EBRD, and we were able to meet the colleagues from the TCFD, and we were a bit confused about this whole climate risk notion. It was very early on. 2018 is only a few years ago, but there's so much that's happened since to further our understanding. But we basically became the first African financial institution to publicly support at least the vision of the TCFD. Since then, we've collaborated with so many peers. David Carlin is here today. We actually piloted the transition tool, the transition check tool. We collaborated with IFC on their tool, the CAFI2 Climate Assessment for Financial Institutions. So this strategic voluntary approach coming from the top management very quickly translated into real systems and seeing how the bank can really further its leadership on this domain. And KPIs were being set up. So basically from 2008 to 2018, it was the building blocks and the maturity that we wanted to reach. So the second part of what I wanted to tell you about the story of Bank of Africa and how it mainstreamed these risks is that the facility of the maturity of the ESMS enabled a quicker or a better the ongoing integration of climate risks today. So we began to build capacity. We started to do a group-wide training, actually, even during the pandemic, to talk about climate risks and also ENS risks from a governance perspective. With the IFC, we also very quickly, already during the pandemic as well, we did virtual trainings on how to identify climate assets in the portfolio. So this time it was a different population. We, of course, invited the risk colleagues, but across the continent, we brought in the business people who until now were kind of, not really at the forefront of the whole ESMS. They know they have to do it, but they're not really the ones who are being called to be trained. So they were very happily surprised to say, oh, now I can, when they said we don't have any sustainable finance, in Togo, for example, we looked at their portfolio and found a lot of sustainable agriculture that were one of the leading banks in agriculture in Togo. So we said, yes, you do. We were able to find amazing examples of climate responsible financing in a hairdresser, energy efficiency, in a bakery, and so on. So giving the confidence of the banks to say, you're not climate risk right now, but you already have climate assets in your portfolio. There's an ESMS, putting them together. So right now, where we sit is we've anticipated the regulation, because what you should know is that in Morocco in 2019, there was a new climate risk directive. It's also quite voluntary, but all the banks now are scrambling to apply it. We are proud to say that we advised the central bank ahead of launching this. We were able to have direct talks with the regulator. A very key lesson is to maintain that exchange. So we were ready for it when it came. And also in the meantime, by 2018, our bank also made some very firm commitments. We ceased financing coal power plants in Morocco completely. Across the group, it's a 10% firm threshold. We are way below that. So the idea is also trying to put in some things. We updated right before actually the central bank guidelines came about. We had already updated our group risk policy. And you see, this is very bit by bit instilling as we go. So by the time the guideline came out, we were kind of ready to tackle the tools that David Carlin mentioned about, and also the methodologies. I look at the presentations of development banks, and thank you very much to the Mainstreaming Initiative for giving us this platform for me in a commercial bank to say, wow, this is how you consider macroeconomic impacts. Oh, this is how EBRD does its TCFD report. You're really leading on this front, because we are more preoccupied with how to improve the bank's profitability, which, as you know, is kind of the point of the bank. Even our regulator says you need to keep your ratios. So you see, trying to help the bankers, that's my role, to advise them, to listen to you guys and see what bits that you propose of your methodologies can be transposed to our portfolio. So, by the way, in Morocco, banks are not required yet to do any climate stress testing, but we are already doing our research and development at Bank of Africa to anticipate access to data is an enormous challenge in Morocco and across the whole African continent. There's a lot of taxonomies to navigate, but we don't have anything Africa for Africans, and I'll talk about that in my next point. But just to say that in addition to what I've told you about in terms of risk, we built a lot of credibility because our bank also manages its direct impacts, which is, an environmental management system, an energy management system. So those are the small bits. I know it's not what is significant impact, but also to help our employees understand that we have a role directly and indirectly on climate. Last but not least, I want to go a little bit beyond risk and go into climate related opportunities. After all, TCFD is risk and opportunity. In 2008, when we set up our ESMS, we completely forgot opportunities. It was until 2015 that we said, wait a minute, going to a client and telling them to improve their impact, why don't we develop products to offer them? So when you tell them, here, we detected some potential impacts, and here's how you could finance them. We discovered the wonderful model of blended finance, which we became ambassadors / strong advocates of. And basically, the idea is not just financing, but mixing that with a technical assistant for the client, in the form, for example, of an energy audit or a water reuse audit or something like that, and a little bit of a sweetener. We can talk about that in another panel, but the current sweetener in Morocco is subsidies. Subsidies work extremely well. They're highly successful. Of course, the client, especially in emerging markets, clients are very responsive. But in another talk, I would like to say what other incentives we could develop, because you do hit a ceiling after a while with only subsidies. So in parallel to the ENS risk management system, we developed 3 key products as of 2015. One is actually with EBRD. Very, very proud to say we were the first bank. Because of everything I've discussed so far, we were the first bank that gravitated towards the fantastic blended finance product, MORSEF, Morocco's Sustainable Energy Financing Facility. We were the first bank to be on board. We've very quickly dispersed the first 35 million, and then 55 million, 65. We've reached over 100 million in financing, $100 million euros in financing SMEs to better integrate their to finance their transition, basically, to use the GET model that my colleague from EBRD mentioned. So basically, in parallel to all these risks, developing products in energy efficiency, water treatment with l'AFD, and the European Investment Bank, and then finally another waste management product with FMO and the European Investment Bank. I have to admit that the water and waste products, we tried to go beyond subsidies. We did it on our own. We called DFIs, whoever was on board to help us. That was also the topic for another panel, but also it was a really interesting experience to do it by yourself. And we'll be launching actually a booklet very soon, a short one on our experience of the first water facility actually regionally. So basically, by developing these climate opportunities, we were able to show the palpable potential profits from such a transition to our bankers that I always felt so far that it was just a compliance issue. Oh, you want your ESMS screening? Here it is. Go to the risk department, to the back office, and get the reporting. We wanted to go beyond that. Today, we're working on all our business opportunity loan officers to know exactly what to look for. Today we're very proud that since 2015, every banker, the loan officer in any region in Morocco, every time they look at a project, they always look at the energy efficiency dimension. For us, that's a really huge success. It means we've been doing our work well. So in addition to these financing facilities that are basically loans, we had the first green bond. We're about to launch our first social bond. We also do huge project finance of wind energy. And every time we find something interesting, a panel, an event, a potential financing, we invite our opportunity folks at the bank. So my mission is to align the portfolio with SDGs. I will end it here. Thank you very much. I'm sorry if I've taken too much time. But the idea is the way we've mainstreamed it is we first took a voluntary approach, and then we kind of perfected our ENS risks, led it to maturity. Offshoot of that is climate risk. Our leadership enabled us to be part of the UNEP-FI TCFD working group, to interact with brilliant minds like David's, brilliant institutions like the EBRD. So today, how can we further incentivize positive impact financing of transition? And we really look forward to our first TCFD report between now and March, and to come back and say, here's what we actually found in our portfolio. Thank you so much for your attention, and I hope that wasn't too much. I tried to do it in a speedy fashion.
Thank you very much, Amal, and thank you for mentioning the initiative. And I would like to thank you on behalf of the initiative as well for showing what a commercial bank can do, and yes, very useful. Thank you very much. Rodrigo, I'm afraid you're going to have to stick to your 5 minutes because we're very short in time now. And we have another event coming up afterwards. So if that's okay, I'll pass it over to you. And yeah, sorry about that. But we were lucky enough to have a lot of panelists. But that's the other side of the coin, is that we don't have so much time for all of them. But thank you very much, and pass it over to you, Rodrigo.
Thank you, Claire. No problem at all. First, I would like to thank you for the invitation to be here today. And well, the best part of being the last one is that everyone told everything about climate risk methodologies and assessment here. So I'll focus on BNDES strategy here and just make a brief comments on what was said before. We at BNDES have been working with the climate agenda for a long time, especially as a public development bank. We have been acting according to the public policies that we have in Brazil. We have been financing renewable energy for a long time, more than 20 years right now. BNDES was acknowledged as one of the top 3 renewable energy financiers in the world by Bloomberg, with over $30 billion, for example, on the last 15 years, I guess, in renewable energy finance. And that's something that we have been doing through our own internal policies, giving better conditions to renewables. And since 2016, we haven't financed new coal-fired power plants. And last year, we issued updated our exclusion list to include formally the exclusion for the coal-fired power plants, and also to mining coal designated to power plants. So we do not finance anymore any of these projects. We have been working closely with our central bank, and they issued last year new regulations aligned with TCFD on the transparency. And as a public development bank, we have always been very transparent and with a huge concern about the accountability of our operations. And well, that's the part of the strategy here. And the point that I would like to highlight here is that we have new challenges regarding climate finance. And for those new challenges, we need new approaches. And Amal just mentioned about the blended finance. We are working on blended finance instruments right now at BNDES for some specific sectors. We also have been working with linked loans in the past few years, trying to get commitments from our clients to either issue their GHG inventories or committing to reduce their emissions. So, and when we get that, we get a lower interest rates for the client. So that's something that we bring together as a sweetener for them. Okay, you commit with something, but I give you something in return, rather than having command and control policies to well, punish them if they don't do what they commit to. So that's how we have been working in the last few years. And just to keep in the 5 minutes here and mention about what David mentioned before, and Laurent and everyone here about the methodologies and the climate information tools. We have developed a framework back in 2019, specifically for infrastructure projects. BNDES is the biggest financer for infrastructure projects in Brazil. to assess climate risk in projects. And the key here, there are 2 points that we thought that they are very important, very difficult to have. The first one, everyone mentioned here, is about the information tools. And we designed the methodology so we can change the information tools that we use, so we can have any information provider in the future. Because we understand that, as mentioned, I guess, what's David, we are having so much advance in information and climate information. And remember that Brazil is a very large country, a continental country, I would say. So we have many different climate realities here in Brazil, and various impacts as well. And the second point is that we understood that we need to build internal capacity to fully understand what are the information that are provided by those tools. So those are the 2 main challenges that I think that we have to face in the near future. And just to finish about on how to bring together our clients and how to improve climate risk assessment in developing countries. The opportunities that we find when assessing a project here, a climate for the climate risk perspective, we try to understand how our clients are approaching climate risk on their operations. So when you get on the first screening, and I'm not going through the methodology here, but it's almost the same thing that everyone just mentioned. We have a first screening, low, medium, high risk. And if you find that's a high risk project, we talk to the client and see how he manages climate risk. And if he is well suited to manage these risks, we can operate with that, no problem at all. And in that case, when they don't have the kind of climate risk management that we think that's adequate, we can try to bring to them technical assistance and try to find something that we can help them get better practices. So that's how we are trying to work. We are right now finishing our pilot stage on the methodology here. And next year, we will be probably put that in place for every new project that is submitted to BNDES. I hope I stick to the 5 minutes here, Claire, just to make it easier for you. So thank you very much for the opportunity to speak with you.
Thank you so much, Rodrigo. Yes, for sticking to the 5 minutes and also for summarizing, I think, quite well the discussions today. And I think you mentioned a lot of the things that have been repeated by our different panelists. And so we start to see the pattern here, and it's very, very interesting. I'm being told we don't have time, unfortunately. I'm sorry, we asked you to think about another question on how you guys could collaborate working on disseminating climate risk. Unfortunately, we don't have time for that. I can encourage you to collaborate through the initiative is one of the ways, just to summarize it very quickly, but I'm sure there'll be many other opportunities to do that. So sorry, we don't have time for that. I also realized I forgot to thank AFD in the introduction for co-organizing this event with us. So yeah, and I'll close it with that. Thank you very much to all of you for the very, very interesting discussions. That's why I didn't cut you, but unfortunately it doesn't give us much time for the second question. But yes, thank you again for being here, for taking the time, and I hope we'll see you again soon on another event to continue the discussions. Thank you very much.
Thank you very much. Have a great day.
Thank you, everyone. Great day for you.
Thank you. Goodbye.